Because what we discussed here, right? What is your investment thesis? Why would you hold your tokens, buy tokens, or not? Can be relevant, right? In our case, right, if we choose the investing route of things, and it is not as black and white. If we're gonna look at Investopedia, link is in the description. We're gonna use that as our guide rails. I like to make trading and investing very black and white, just to get the point across. Oh, and to make everything very clear, I know this is no legal meaning, but we are not financial advisors. We're just a bunch of retards that were very, very lucky buying and finding and buying a token that has very good potential. But we did learn a thing and a trick or two. I was actually looking at starting off with a diversified portfolio before I went into Quant, dumped all my profits from there into this. But yeah, do not regard this as financial advice. Do your own research and form your own opinions, right? Everybody has different needs. Everybody has different wallets, different risk appetite, time horizons, and so on. So that being said, let's itchy ear. Pulling apart my earbuds, really nice. We're gonna have a look at the Investopedia thing, and then we'll make a little discussion out of it, because we also have another 2 topics we want to cover, and we were attempting to keep this episode around an hour. How long are we in, Tim, by the meantime?
I think we're in for, let's see, 19 minutes, 15 seconds. So we had like 15 minutes of introduction, which is longer than usual, but I'll take it.
All right. So what you see on the screen right now is Investopedia. Investopedia, in my opinion, is a very nice resource to get what you see here, an overview of topics. You can get a very nice feel for what something means. Generally, the terminology, if you look for a specific term, you can find it on Investopedia, and you can, to a degree, trust what is written there, right?
Yeah, it's a gem on the internet, in my opinion.
Yeah, it's moderately
there.
Curated, so it is not like crypto Twitter, where every idiot monkey with a keyboard can throw shit on there. So you can use this here. This is fact checked and it is reviewed, which is nice. So if you want to do some research, dive into this. If you don't agree with something, doesn't mean that it's wrong. Yeah, that's for the linkies out there. Sorry, couldn't resist. Use this and the information you find here to do your own research, DIOR, further if you want to. So, investing versus trading, what's the difference? Investopedia says, right, investors generally seek larger returns over an extended period through buying and holding. Traders, by contrast, take advantage of both rising and falling markets to enter and exit positions over a shorter time frame, taking smaller and more frequent profits or losses. The or losses is not in there, but I want to add that because we'll get to that in a bit. Yeah, so the key takeaways: investing takes a long-term approach to the markets and often applies to such purposes as retirement accounts. Trading involves short-term strategies to maximize returns daily, monthly, or quarterly, and investors are more likely to ride out short-term losses, while traders will attempt to make transactions that can help them profit quickly from fluctuating markets. Yeah. So this for most people will be known, right, Tim? Does this sound familiar? Or
it really does, yeah. You could say that trading is still like investing is long-term trading, but
yeah, Yeah. It's the larger returns over an extended period through buying and holding. To me, that differentiates um, investing versus trading. So looking at quant, right? I'd like to regard myself as a quant investor. I did my research. I know in depth, to a degree, what I'm buying, what it does, why, how it will possibly be profitable in the future. And I have a longer time horizon for this, right? Like, let's say up until 2030 at least.
I think
Um,
to add one thing to it, like I think this, I agree with this definition. I also think like some things get lost in the language here. So, for example, in Dutch, you would have investeerders and beleggers. And the first one would be an investor, and the second one is kind of, you can translate this in English. There's no, I'm not sure. There might be a synonym, but like the first one implies that you actually invest in a company, like that you actually become part of it. And the other one is more like, I'm just gonna throw some money there. I'll let it stand for a while. And I'm not
I have to disagree. I think it is both
okay. I
the
might be.
same thing. Well, I think what you're confusing it with is investing is buying into a company at a bigger scale
Yeah. Okay. Fair
than
enough. That might also be the case.
what we
Yeah.
call beleggen. Is kind of like speculating. Um, maybe
On
that's
a long term, on a long time frame. Yeah. That might
yeah.
be true.
So I mean, it's same as English. Uh, the word love has multiple meanings. So you have a lot of different words for the same thing in Dutch. Not really a good
Yeah.
analogy, but
No.
um,
But that's the problem with definitions. Like you can't come up with one perfect definition because there are too many.
yeah.
Um,
But in general, even if you go onto Robinhood
outcomes.
and you
Yeah.
buy fractional shares, you are still buying part of the company. So as long as you buy stocks, shares, whatever you want to call it, ETF, you are eligible to the percentage of X that you own. So if you own 0.1% of Coca-Cola, you are 0.1% holder of Coca-Cola, and you're eligible for the rewards or the losses. No, to a degree of what you own. Um, Still, trading is also investing, and both traders and investors use similar strategies generally to a degree, right? You always want to try and pick the right moment in time, and so we'll get to that.
Yeah.
So
Okay.
more long term, more concentrated bets, generally investing, whilst traders are taking more bets generally for shorter term, whilst also trying to get out of nasty situations, while investors just weather the storm. Um, so, um, building a portfolio for investors versus traders could be a pretty big difference. And we'll get to Warren Buffett after we go to price after this. But he generally initially picked larger bets and researched them well and took larger positions. While traders generally um, use more of a buckshot methodology. Not that they don't research, but they are more inclined to generalize, I think. And I'm oversimplifying. So rather look broader than uh, than narrow and deep. So they are aware of more separate interesting stocks, for instance, or cryptos. They make an assessment of the market, and then they throw in money over multiple channels to multiple assets, but just smaller piles. And then be active while markets are up to capitalize if something gains, or to mitigate losses if something drops. ETFs, stocks, baskets of stocks, mutual funds, bonds. These are all things that we will dive into when we're going in a future episode to asset diversification, because these are all asset classes, not really. Can't find the word right now, blanking, but that you can invest in, speculate on, and some of these things lend themselves, I think, better for trading, others better for investing. This is all information on things you want to consider, right? Price to earnings, fundamentals, etc. And then we come to the investment styles, and this is where it becomes interesting, and it also begins to rhyme with the title of the show. So you have active investors, you have passive investors, and the definitions are actually what you would expect, right? A buy and a hold for the passive, and seeking out particular investments and trying to turn a profit and then sell them is more for the active investing. Time horizon we spoke of as well briefly. For how long are you willing to hold something? How deep does your research go? How far does it extend?
What are we? How would we classify?
What?
On the type of investor. So if you go up on the page, yeah, we are passive active investors, I think. Active passive investors. Because we
Yep. Do you make changes to your allocation of your portfolio regularly?
I do on like perhaps on like every 6 months or so. No, not weekly.
No, then you're passive.
I'm probably
I mean,
passive.
if you're active, that would mean that if you see that the market takes a plunge, you are aware and you're actually acting on it.
I'm not doing that. No.
In my opinion.
No, but we might be the exception that kind of confirms the rule with our little podcast and everything we do to follow Quant, but we don't take any action upon it with our portfolios. It's just there.
I think most people also looking at the Quant trading and on-chain analysis group, link in the description. I think the vast majority of people are also passive investors, but they're active in a community. They just want to be involved.
Yeah, exactly.
They're not really acting on what they're doing, right?
No.
This is what they say. They were trying to min-max certain benchmarks, right?
Yeah, some of us are those active investors. Some people in the community are.
If you're an active investor, reach out. We would love to pick your brain, because most people we know bought DCA and hold, and it'd be a really interesting discussion, very educational to get you on the show. So
I think they're also kind of a different breed than traders. So like traders are actually just looking at markets and don't really care about what they hold, but active investors are generally more interested like in the fundamentals behind it, will still act upon it.
Yeah.
So they might switch narratives. So there's this minor difference which kind of distinguishes between like the traders among us and like the active investors.
Yeah.
But I think speaking for the quant community, also our listeners, I think the vast majority are passive investors. We just see it, we take it for granted, and we're Quamfy.
Yeah. And here, when it comes to time horizon, they speak of more than a year for buy and hold is generally the investing type, like waiting up to your retirement, stuff like this. Oh yeah, this is also interesting. Investors often enhance their profits by compounding or reinvesting any profits and dividends into additional shares of stock. And that is what more people do with the staking, right, in crypto. People stake, for instance, their check D or whatever, and they do that in a pool, and then their profits automatically get reinvested. So you get the compounding interest going on top of your dividends reinvested or your interest. Still passive, and that's actually what I'll be eyeballing for the future. Later, we'll get to that. So trading involves more frequent transactions. Buying, selling of stocks, commodities, currency pairs, and other instruments generate returns that outperform buy and hold investing. While investors may be content with an annual return of 10 to 15, traders might seek 10% return each month. So that is the thing, right? Do you do your research? Do you have trust in your bet? Did you buy? Do you hold? Do dips matter? Are you looking at your screen nonstop, stressed out whether you want to buy or sell or not? Some people get a rush from it. But yeah, you'll get better returns if you're an active trader and you're really good. Usually they'll outperform people that just hold. At least that's the idea. And I'll bet there are people on Wall Street that are very good at this. So trading profits are generated by buying at a low price, selling at a higher price with a relatively short time period. Reverse is also true. Trading profits can be made by selling at a higher price and buying to cover at a lower price, known as selling short to profit in falling markets. Buy and hold investors wait out less profitable positions. Traders seek to make profits within a specified period of time and often use a protective stop loss order, etc. As you can see, complexity goes up because the risk goes up, right? Stop losses. I've used it once, I think, just to try it, and apparently I fucked something up with my leverage and I lost all my shit.
I used them in my early days, like when I was still on I told you about this, like this Dutch equivalent of Robinhood in the past. Go to Richard's episodes in the beginning. I used them then, but I would usually just hit my stop loss, and then I would still lose a ton of money. I'm not a good trader, guys.
Yeah, and they define it here further, right? So for trading, you have position traders held for months to years. So that could still be right. So let's say you want quant. I mean, this edges towards DCA. You just accumulate what you can whenever you can. Swing traders holding positions for days to weeks, trying to ride the cycles. Just easy, bro. Just buy low, sell high. And then they start off with 10, then they get 10.5 Q&T after one cycle. Then they have 10.5 to invest, and then they'll make another, but then they make a whole Q&T and so on. Day traders hold their positions throughout the day with no overnight positions. Obviously, this is not relevant to crypto because crypto is a 24-hour economy, and trust me, stocks will go there as well eventually, I think. Or at least the derivatives will. And then you got scalp traders. They hold trades for seconds to minutes with no overnight positions. And as you can see, the lower you go on this list, the more involved it gets. Trading styles are based on account size, amount of time dedicated, level of experience, personality, and risk tolerance. Yeah, so this is interesting. I mean, we've all seen Wolf of Wall Street, and there's also one with Michael Douglas, I forgot. So Wall Street, I think it's Wall Street. It takes a certain personality to be a scalp day swing trader, I think. I think most people are not made for the high risk, high energy, fast changing pace of everything.
They are for like a couple of weeks or months at best, and then they wander away in huge losses, saying everything is a scam.
Yeah. So if we scroll down to the key differences, right? So the length of time that an investor and trader hold their asset diverges. Noted above, investors normally have a longer time horizon in mind, typically more than a year. Traders, on the other hand, normally hold on to their assets for a short time frame. So the potential for loss is among the key differences between the two. There's a risk of losing your money regardless of whether you hold it for the long term or for a short period of time, but the risk increases for traders for several reasons. They tend to hold onto their assets for a shorter time frame, and they are also more open to holding a diverse set of assets, those that investors may not necessarily keep in their portfolios. This includes futures and swaps. So unlike investing, trading requires a great deal of time, effort, understanding of the market, and research. Many traders are experienced, have a greater sense of how the market works, while investors may also be experienced. A great many aren't. As such, they may rely on the expertise of financial experts, such as financial advisors. So, what's more profitable? Those things I recommend read for yourself. Bottom line, this is people often confuse investing and trading using the terms interchangeably, but it's easy to see why, because there are some distinct similarities, such as the need to open accounts, deposit money, buy, sell assets, but the two are very different. Investors have a much longer time horizon, traders, we all spoke about this. So why did we name this? Do you make money while you sleep or do you trade?